Welcome to The Explainer. Today, we're going to break down a really clever investment strategy for your CPF. Now, this isn't for day traders or the impatient. It's a plan for the disciplined investor. And the idea is pretty simple. You build a financial fortress, and then you wait for the absolute perfect moment to ambush the market. So let's just dive right in with a question that, let's be honest, probably keeps a lot of us investors up at night. Is it actually smart to put your money into the market when it just feels like prices can't possibly go any higher? You know that feeling? It's called peak risk, and it's a very, very real concern. But what if there was a way to take that exact fear and flip it completely on its head? The strategy we're going to walk through today doesn't just help you manage that risk. No, it actually turns that fear into your greatest weapon. It makes a market panic the very trigger for your biggest potential gains. Okay, so first things first, before you can even think about going on the attack, you absolutely need a strong defense. So let's talk about building the foundation for this entire plan, a concept we're going to call the 4% fortress. The very first move is incredibly simple, but it is so powerful. In Singapore's CPF system, you've got these different accounts, right? Well, this move is all about systematically transferring money from your ordinary account, or OA, which earns 2.5% a year, over to your special account, or SA, which earns a guaranteed 4%. Just by doing that, you instantly create a 1.5% performance boost on every single dollar you move, and it is completely risk-free. In the finance world, they call this a guaranteed carry trade, and seriously, it is one of the highest government-backed returns you can find anywhere on the planet. You've essentially just created a guaranteed gain out of thin air. But, and this is the crucial part, this is a one-way street. Once that money goes into your special account, it is locked in for retirement. That's it. That's why you have to think of it as your endgame capital, and it means any plan to invest it has to be incredibly disciplined and very, very well thought out. So the fortress is now built. That capital is sitting there, safely compounding away at a guaranteed 4%. Now we get to the real heart of the strategy, the art of the patient, disciplined wait. This quote from the source material just captures the mindset perfectly. You're not just sitting on the sidelines hoping for the best. You're strategically setting a price, a limit order for your life, and you're just waiting for the market to come to you. It's a completely active and strategic stance. And this brings us to a really important idea called a hurdle rate. Think about it. Since your money is already making a safe, guaranteed 4%, any other investment you consider has to do better than that. It has to promise a return that clears that 4% hurdle plus any fees. If it can't, you just don't do it. Simple as that. And let's be clear, this waiting isn't passive. It's a powerful, offensive move. Why? Well, it completely eliminates the risk of buying at the top. It ensures you buy at a good price, with a margin of safety. And maybe most importantly, it gives you psychological stability. While everyone else is panicking during a market crash, your fortress is totally secure and your capital is ready to go. This table here just lays it all out, side by side. You can see the two phases of the strategy so clearly. You start in this defensive state, zero risk, guaranteed returns, while the market is greedy and at its highs. Then, when the market flips to fear, you pivot into an aggressive accumulation phase, taking on smart, calculated risk. All right, so if we're patiently waiting to ambush the market, what exactly are we planning to buy? Now, this isn't about trying to pick the next hot stock. Nope. It's about choosing the right vehicle for the ambush. And the target is a specific CPF-approved fund, the Schroder Multi-Asset Revolution. What's interesting about this one is that it's a fund of funds. That means it doesn't buy individual stocks itself. Instead, it invests in other specialized funds, which gives you this massive diversification across literally thousands of different assets. And when you look under the hood, you can see why it's built for balance. You've got about 62% in stocks or equities for growth, but you've also got this really solid 38% chunk in bonds and cash. That part is designed to give you stability when the markets start to get choppy. And you can see that stability right here in action. Think of those bonds as a parachute. For example, during the 2022 bear market, the S&P 500 just plunged, right? It fell about 25%. But this fund's design cushioned that blow. It only fell about 15%. So yeah, it still goes down, but the landing is a whole lot softer. Now, if you're wondering, okay, but why are we tracking the US market for our signal? Well, this slide shows you exactly why. The fund's single largest holding, almost 23% of it, is in a US large cap fund. that directly links a big chunk of this fund's performance to the S&P 500, which makes it the perfect signal for our ambush. Okay, so this is where it all comes together, the final phase, the ambush itself. This is where all that patience pays off and where the math becomes, well, pretty darn compelling. So the whole plan really just boils down to these 4 crystal clear steps. 1, build your 4% fortress. 2, wait for that specific signal, the S&P 500 dropping 20%. 3, deploy your capital right when everyone else is panicking. And 4, you just hold on and capture the recovery. This is the number, -20%. That's the signal to act, a 20% drop in the S&P 500 from its last peak. That is the official definition of a bear market. And historically, it's an event that happens roughly once every 6 or 7 years. So yeah, it's rare, but it is predictable. And here is the beautiful, simple math that makes this whole thing work. After a market falls by 20%, it doesn't need a 20% gain to get back to where it started. No, it needs a 25% gain just to break even. And by buying at the bottom, your capital is perfectly positioned to capture that entire 25% move up. Just look at the difference between these two paths. It's really stark. The investor who just holds on through the drop, they lose 20%, and then they need that 25% gain just to get back to zero. Meanwhile, our disciplined investor, they earn a guaranteed 4% the whole time they wait, and then they capture that full 25% recovery. The difference in what the source calls wealth velocity is just massive. So, to wrap it all up, what are the big takeaways here? First, build that rock-solid foundation with your 4% special account. Then, use patience not as a weakness, but as your #1 offensive weapon. And finally, have the discipline to deploy your money when there's blood in the streets. Remember, the goal here isn't just about getting wealthy. It's about building what the source material calls comfortable wealth. And that leaves us with one final question to just think about. In a world that is completely obsessed with finding the next hot stock and chasing those quick returns, maybe, just maybe, the most powerful market-beating advantage you can possibly have isn't a secret tip, but simply unwavering discipline.